The modern financial industry is a masterclass in obfuscation. It is a multi-trillion-dollar machine meticulously designed to convince the average person that wealth is a mystical code, a secret door that only opens with the right software, the right insider tips, or the right hustle. If you scour the internet for advice on how to build wealth, you are instantly submerged in a digital cacophony of promises. You see influencers flashing rented luxury vehicles, teenagers peddling high-ticket dropshipping courses, and day traders screaming at their monitors while urging you to follow their signals on obscure options trades. This entire ecosystem is built on a single, poisonous premise: speed. They need you to believe that if you just buy their course, use their platform, or follow their unique system, you can bypass the decades of slow, methodical labor required to build real security. But here is the brutal, inconvenient truth that the get-rich-quick industry will never admit. Speed is the enemy of wealth. The faster you try to move, the more likely you are to trip. The desire for instant gratification is the fundamental flaw in the human psychological operating system that keeps the vast majority of people trapped in the cycle of financial mediocrity. To understand true wealth, we must strip away the noise and perform an autopsy on the philosophy of Warren Buffett. This is not a biography of a man. It is a masterclass in behavioral finance and logical decision-making. Buffett built a $130 billion empire, not by chasing the next trend, not by gambling on volatile assets, and certainly not by trying to outsmart the market on a daily basis. He did it by being, by all traditional standards, overwhelmingly, almost painfully, boring. Consider the trajectory of his success. Warren Buffett's net worth was roughly $300 million when he turned 50. By the time he was 60, it had ballooned to $3.8 billion. Today, it is over $130 billion. That exponential curve did not manifest because he changed his strategy in his 50s. It manifested because of the sheer, crushing power of time combined with small, consistent, daily choices. These are not choices reserved for the elite in Omaha. They are accessible to anyone with a bank account and the iron discipline to execute them. Most people operate their financial lives completely backward. They treat their personal finances like a bucket with a hole in the bottom. You receive your paycheck, you pay your rent or mortgage, you cover your utilities, you buy groceries, you pay your car note, you spend money on weekend leisure, and then, only if there is a surplus, you toss a few dollars into savings. This is the residual savings model, and it is the primary reason why the average household has less than a few $1,000s in liquid assets. You are letting your lifestyle dictate your savings, rather than letting your savings dictate your lifestyle. Buffett's rule is an inversion of this. Do not save what is left after spending. Spend what is left after saving. This is not a pithy quote. It is a fundamental shift in cognitive architecture. When you rely on willpower at the end of the month to decide to save, you are setting yourself up for failure. Human psychology is hardwired for immediate gratification. If the money is sitting in your checking account, your brain perceives it as available capital, and you will find a way to justify spending it. This is known in behavioral psychology as the availability bias. If the money is visible, it is vulnerable. To achieve financial freedom, you must remove the human element entirely. You need to build a system where the saving happens before you even have the chance to touch the capital. Think of your finances like a major corporate entity. A company does not wait until the end of the year to see if it has money left over to pay its employees. It treats capital allocation as a non-negotiable operating expense. You should automate your finances with surgical precision. Set up a system where, The second your income hits your account, a predetermined percentage is automatically routed into your investment accounts. Whether it's a 401k, an IRA, or a low-cost brokerage fund, that money should vanish from your sight before you have the chance to spend it on lifestyle inflation. When you automate, you force your lifestyle to adapt to the remaining balance. You are not sacrificing. You are simply recalibrating your living standards to a level that ensures your future self is wealthy. This eliminates the emotional friction of the choice. You stop having to be good every month, because your system is doing the heavy lifting for you. You are essentially paying yourself first, and the world gets whatever is left. That is the first pillar of the Buffett framework. Systematized frugality. This is the antidote to the hustle culture mentality that assumes the only way to save more is to earn more. Increasing your income is excellent, but if you do not have the systems in place to capture that excess capital, you will simply inflate your lifestyle to match your new earnings. Automation ensures that your wealth grows in lockstep with your career, regardless of your emotions, your fatigue, or your changing desires. If you asked Warren Buffett for his biggest secret, he would not show you a complex AI-driven trading terminal or a secret algorithm. He famously points to a stack of annual reports and says, "Read 500 pages like this every day." That's how knowledge works. It builds up, like compound interest. But what exactly is he reading? He is not reading market commentary, sensationalist headlines, or financial news sites that exist to generate clicks. He is reading the source code of business, the annual reports, the 10Ks, and the primary financial statements. Most retail investors look at a stock and see a fluctuating line on a screen. They look at the price action and try to guess what the market will do next. This is the definition of gambling. Buffett, on the other hand, looks at a stock and sees a business. He does not care about the ticker. He cares about the underlying machine. To invest like him, you must learn the language of business, which is accounting. You need to be able to open an income statement and know exactly what you are looking at. You need to understand the relationship between revenue, cost of goods sold, and gross profit. If a company has a durable competitive advantage, what Buffett calls an economic moat, it will show up in the margins. If a business can consistently maintain high gross profit margins over a decade, it means they have pricing power. They are selling something the market values, and their competitors cannot easily replicate it. Then move down the statement to the operating expenses. This is where most companies bleed out. Are their selling, general, and administrative expenses growing faster than their revenue? If they are, that is a sign of a bloated, inefficient management team. By spending just 30 to 60 minutes a day analyzing these reports, instead of mindlessly scrolling through social media, you begin to develop an investor's intuition. You stop reacting to market panic. When the market crashes, the average person sees red and sells out of fear. The person who understands the business sees the crash and realizes that a high-quality asset is now on sale. This is how you gain the confidence to hold through the volatility that destroys the wealth of the uneducated. You are not investing anymore. You are business analyzing. And when you understand the business, the stock price becomes secondary to the value of the company itself. This shifts your psychology from fear to opportunity. When the rest of the market is dumping assets, you are looking for the companies with strong balance sheets, manageable debt, and consistent free cash flow. You become a buyer when everyone else is a seller, simply because you have the literacy to see value where others see chaos. Here is the most dangerous psychological trap that keeps the middle class running on a corporate treadmill until they are 65. Lifestyle creep. You work hard, you get a promotion, and your income increases by $20,000 a year. You feel like you've made it. You trade in your reliable car for a luxury SUV with a $700 monthly payment. You move into a larger home in a more expensive zip code. You upgrade your wardrobe. You start dining out at places where you don't even look at the prices. Suddenly, your new, higher income is entirely consumed by your new, higher expenses. You are making more money than ever, yet you are further away from financial freedom than you were when you were broke. This is the hamster wheel. Warren Buffett is worth over $130 billion, and yet he still lives in the same 5-bedroom house in Omaha that he bought in 1958 for $31,500. He does not drive a new supercar every year. He does not live in a multi-million-dollar mansion. The point is not to live like a monk or to deprive yourself of the fruits of your labor. The point is to understand that money is a tool to buy freedom, not a tool to buy status. Every dollar you spend on a status symbol, a depreciating asset, is a dollar stolen from your future self. Consider the opportunity cost. If you take $50,000 and buy a car that will be worth $10,000 in 5 years, you haven't just spent $50,000. You have sacrificed the potential of that money being invested in an asset that grows at 8 to 10% per year for the next 30 years. You are sacrificing your future freedom for a current illusion of status. True financial freedom is the ability to walk away from any situation you don't like because you have the resources to sustain your life without working. That is a kind of power that no luxury car can ever provide. Buffett's daily choice is contentment. He knows that true financial freedom is having total control over your time, not having the flashiest lifestyle in the neighborhood. Avoiding lifestyle creep is not about deprivation. It is about preservation. It is the conscious decision to reject the status games that other people are playing. You might be listening to this and thinking, "This sounds great, but I don't have the time to analyze financial statements. I have a job, a family, and a life. I just want to grow my money." Buffett has a brilliant solution for this too. It is the concept of the circle of competence. Every investor has a boundary. Inside that circle are the industries and businesses you genuinely understand. If you understand how retail works, stay in retail. If you understand technology, stay in technology. The biggest mistakes investors make are when they venture outside of their circle of competence because they hear a hot tip about a sector they know nothing about. But what if your circle of competence is small? What if you are a doctor, an engineer, or a teacher, and you don't have the time to be a professional stock picker? Buffett is on the record stating that for the vast majority of people, the best investment is a low-cost S&P 500 index fund. When you buy an index fund, you are buying a slice of the 500 largest, most stable, and most profitable companies in the United States. You aren't trying to beat the market. You are becoming the market. You are betting on the long-term ingenuity and growth of the American economy. If a company inside the S&P 500 starts to fail, it is eventually purged from the index and replaced by a growing, high-performing company. The index cleans itself. This is the ultimate low-maintenance, high-reward strategy. You don't have to watch the news. You don't have to stress over earnings calls. You simply funnel a portion of your income into the index every single month, regardless of whether the market is up or down. This is called dollar-cost averaging. When the market is high, your money buys fewer shares. When the market is low, your money buys more shares. Over 20 or 30 years, this consistency creates a mathematical outcome that is almost impossible to beat, even for professional Wall Street traders. The daily choice here is consistency and ignoring the noise. While everyone else is trying to day trade the next hot tech stock or timing the crypto market, your job is to relentlessly, steadily funnel money into the S&P 500 month after month, year after year, and let the historical compounding do the heavy lifting. The index fund is the great equalizer. It allows the person working a 9-to-5 job to benefit from the growth of the greatest companies on earth without needing to be an expert in finance. It is the ultimate rejection of the expert class that tries to convince you that you need to pay them fees to manage your money. By keeping your costs low and your exposure broad, you are capturing the growth of capitalism itself. The final component of the Buffett method is perhaps the most underrated: the ability to endure boredom. In a world that celebrates the dopamine hit of the trade, the volatility of the crypto market, and the excitement of the next big thing, the Buffett approach is incredibly dull. It requires you to sit on your hands while everyone else is panicking. It requires you to stay the course when your friends are getting rich on speculative assets that you do not understand. But financial freedom is not an event. It is a slow, methodical accumulation of choices. It is the choice to pick the boring, long-term index fund over the exciting, speculative trade. It is the choice to drive your car for an extra 3 years instead of upgrading. It is the choice to pick up a book on accounting rather than binge-watching a series. The math of wealth is brutally simple. It requires no genius-level IQ. It requires no inside information. It requires only the discipline to keep making these boring, correct choices day after day, year after year. At the end of the day, you have to ask yourself, what is your objective? Do you want to look rich to strangers on social media? Or do you want to be wealthy enough to control your own time? If it is the latter, you do not need a secret formula. You need the discipline to automate your savings, the curiosity to learn how money actually works, the wisdom to avoid lifestyle creep, and the patience to let compound interest do the heavy lifting. This is not about being perfect. Everyone slips up. Everyone buys something they did not need. Everyone makes an emotional investment choice at some point. The difference between the wealthy and the broke is not that the wealthy never make mistakes. It is that they have a system that protects them from the catastrophic consequences of those mistakes. The Buffett method is the ultimate fail-safe. By investing in yourself, your knowledge, your discipline, and your habits, you create a foundation that cannot be taken away by a market crash, a recession, or a changing job market. You are not relying on the luck of a single stock pick. You are relying on the compounding effect of your own intelligence and persistence. You must realize that the market is a transfer mechanism. It transfers money from the impatient to the patient. When you are impatient, you are the one paying the premium. When you are patient, you are the one collecting it. This is why the vast majority of day traders fail. They are attempting to trade time for money in a way that the market is designed to reject. You, conversely, are using time to build a compounding engine. The circle of competence concept is also a psychological filter. When you admit that you don't understand an investment, you are actually protecting yourself. The most dangerous investor is the one who is overconfident. When you stay within your circle of competence, you are not limiting your wealth. You are limiting your risk. This is the hallmark of the mature investor. Consider the concept of the fat pitch. In baseball, a hitter does not swing at every ball. They wait for the pitch that is right in their zone, the fat pitch. They can stand there all day and let the balls go by. They are not penalized for not swinging. In the world of investing, there is no called third strike. You can wait years for the perfect opportunity, a market crash, a massive mispricing of a great company, a systemic panic, and when that opportunity arrives, you strike. But to have the ability to strike, you must have the capital saved and the temperament to be calm. This requires a mental detachment from your bank account. You cannot view your investments as spending money. You must view them as an asset base that is growing. When the market drops 20%, the amateur panics and sells because they view their balance as their worth. The professional looks at their balance as a reflection of the current market mood, not the intrinsic value of the assets they own. If the intrinsic value of the business remains, the temporary price drop is merely a statistical anomaly. So start today. Not tomorrow, not when the market gets better, not when you get a raise. Start with what you have. Automate your savings. Define your circle of competence. Read the annual reports. Live below your means. And most importantly, stop looking for the shortcut. The shortcut asterisk is asterisk the long way. The patience you cultivate now is the capital that will pay off for the rest of your life. That is the blueprint. It is not fast, it is not flashy, and it is certainly not a get-rich-quick scheme. But it is the most reliable way to achieve the kind of financial independence that actually lasts. In a world of noise, choose the signal. In a world of gambling, choose the business. In a world of instant gratification, choose the long game. Because in the long run, your daily habits will determine your net worth, your freedom, and your future. The true test of financial character is what you do when no one is watching. It is the decision to contribute to your 401k instead of upgrading your phone. It is the decision to research a company's balance sheet instead of following a stock tip from a friend. It is the quiet, repetitive work that builds empires. If you look at the history of wealth, you will find that it is rarely built by the geniuses. It is built by the consistent, the disciplined, and the patient. It is built by those who understand the mathematics of compounding and have the temperament to let the clock do the work. The journey of 1,000 miles begins with a single step, but the journey of wealth begins with a single, boring, automated, and disciplined decision. Make that decision today. Set up your systems. Define your boundaries. Respect the long game. The reward is not just money. The reward is the total, uncompromised control of your own time. And in this world, there is no asset more valuable than that. Ultimately, your financial life is a reflection of your philosophy. If you believe in luck, you will behave like a gambler. If you believe in skill and time, you will behave like an investor. Choose the latter, and you will find that the path to financial freedom is not only clear, but it is also remarkably achievable for anyone willing to do the work. The math is settled. The evidence is clear. The only remaining variable is your own commitment to the long-term process. Everything else is just noise. Your habits are your future. Act accordingly.